Well, what a perfect person to have with me, Aaron Dunn, Keystone Financial. Aaron, first of all, appreciate you taking time on the weekend.
I'm always happy to do it, Michael. Always happy to chat on a Saturday morning.
Well, there's so much to chat about. People are saying, what do I do with my money? I mean, that's not unusual. But again, we're back to that environment that, as Andrew alluded to, we're worried that people, in order to get a better yield, are taking more risk. You know, it's the same old sort of credit-worthy thing. If I'll lend you money because I know you always pay it back, and I'm worried about the next guy, so I charge him more. That's how you get higher rates in a lot of instances. Now it's getting more complicated with government and central bank intervention, but that's the bottom line. So talk to me a little bit about how you're approaching the market today.
Well, we take a very consistent approach to the market, so it doesn't change every month or every quarter as the macroeconomic outlook changes. What we've always told people is you need to have a mix of different types of companies in your portfolio. That's how you're going to build a robust long-term portfolio that's going to perform well and manage risk in a variety of different economic scenarios. So that does start with dividend growth stocks, what we call dividend growth stocks. So high-quality companies paying attractive dividends and growing those dividends over time in a sustainable way. And if you look at the data, and we've talked about this a lot at our DIY seminars as well, if you look at the data, the conclusion is just you can't argue it. Dividend growth stocks have vastly outperformed non-dividend paying companies overall over essentially almost any time horizon you look at. Over the last 30 years, for instance, annualized returns overall about 11.6% compared to 0.3% for non-dividend payers. And they're doing this as well with lower risk. So we believe the best way to construct a portfolio long-term is you start off with dividend growth stocks. That forms the foundation of your portfolio. And then you mix in, you can add layers of risk to augment that return. And so that's what we do with our small cap research as well. So these are still high quality companies generating a lot of cash flow, growing a little more risky than our dividend payers, but you're augmenting your return by adding these companies to your portfolio. And then you also look outside of Canadian borders as well, so that you get good geographic diversification. Because our economy here in Canada is just so limited, you need to access the global market. And there's two ways you can do that. One is a lot of the recommendations that we make in our Canadian research are Canadian-listed companies that are actually operating globally and have exposure to the United States, other global markets, emerging markets. Another way to do that is you can actually buy companies that are listed in other countries. So we have our U.S. research service as well, U.S. growth stocks, where we look at companies on the NASDAQ, the New York Exchange, in some cases the very highest level of the OTC, to really try and get a good global exposure in the portfolio. So you take these different types of companies, you mix them together, you focus on quality, and that's how you're going to build a portfolio that's going to be successful for you long term and manage risk.
I just want to mention also that you've got a group of seminars coming up, that go to Kamloops, go to Victoria. You'll be in Vancouver, of course. You're going to Langley. There's a whole list there that people can just get from going to KeyStoneFinancial.com. KeyStoneFinancial.com. But this is the kind of thing that you're dealing with, and this is what I really encourage people, to have a look at. Simply because, learn how to build a portfolio. It's nothing. It won't be over your head or anything like that. But there's proper ways to approach it. And I know you're in Kamloops October 15th. You're in Victoria October 16th. You're at Langley the following day. The following week, October 22nd in Vancouver. Calgary October 23rd. Edmonton the 24th. So I really encourage people. That's the kind of thing. If it's one of those subjects, I always hear about people don't have a financial plan or they don't really understand it. That's the kind of thing you do. Aaron and Ryan Irvine do a great job of explaining, how to set up a portfolio, what kind of things you should think about, and just go through. I mean, that's what we're doing here, is trying to help people out in that way. And especially in this environment. And I know you guys spend all your time looking at and different categories, like you have growth with yield, you have higher level growth, which we've talked about. But just in order, time's never long enough here. But give me an example of something that you're looking at these days that. I'm focusing, Ryan, we had Ryan on a few weeks ago and did a great job talking about some of the more aggressive growth stocks, small caps that they're looking at. But give me something like a solid company with a dividend that you're looking at.
Absolutely, happy to do that. Just to clarify the website, it's actually keystocks.com.
Of course it is.
So people can go to no problem. People can go to keystocks.com, get all the information on the DIY seminars, and just like you said, what we're doing is we're breaking down 20 years of experience in the market and providing people with a simple process and framework to build a portfolio, avoid unnecessary risk, and really avoid many pitfalls that hurt investors. But just on the topic of a very solid dividend growth stock, I'm going to talk about a company that's been a long-standing recommendation in our research. That's Brookfield Infrastructure. The symbol is BIP.UN on the TSX, BIP on the New York Stock Exchange. I've talked about it on your show many, many times. So Brookfield, this is a global infrastructure company, a very solid conservative stock, but also a growth company as well. So they own infrastructure projects all over the world, and these are long life, stable projects that generate stable cash flow. So you look at a company like this, it's growing, but its current cash flow is also very well positioned for a recessionary environment. We originally recommended the company in 2011 at $14.50 per unit. Today it trades at $66 per unit, so great return in terms of capital appreciation based on the financial performance. But what really impresses me is that they have paid out about $12 US in income distributions to their investors over this 8-year period. So that's $12 US. We recommended them at $14.50 Canadian. You basically have your money back on a pre-tax basis and a company that's continuing to grow. I know you always ask, well, it's done great in the past, so why are you still recommending it in the future? Well, they are continuing to grow. So the recent financial performance has been strong, low double-digit growth in cash flow per unit. They have an investment backlog of about $2.2 billion US that they are commissioning over the next 3 years. So we're expecting 2020 to actually be an excellent year of growth. And this is a company that just continues to produce. It pays a very nice yield of about 4%. It's growing that yield every year. The unit price has been appreciating. We believe that the income distribution is very sustainable. The growth is sustainable. And even though it's come up a lot over the past 8 years, we still think relative to the quality that it's trading at a reasonable price. Now, this isn't a company that I want people to go out and buy because they want to get a big return in the next 6 months. That may happen. It's had a great year in 2019, up about 40% so far. But we want people to look at a company like this as something that they want to own and generate income from for at least the next 3 to 5 years, and that's what we're recommending it for. So great long-standing recommendation, but we still think that it has a good, solid future.
Well, one of the things I always like that you guys look into is, okay, so you can pay a dividend, but you got to think how sustainable that dividend is. And there's some, and as you know, you reject many, many companies on that basis. You say, yeah, they paid 6%, but I don't trust them. They're not paying that going forward. So that's one of the things I like about the research that you guys do, is that you have a long look at, hey, fine, it's a great yield, 4%. But is it, can they maintain it? And you go further, of course, in this case, you've just said that it can increase it also, the distributions. But I'm just reminding people, don't get mesmerized by the yield on something. You've got to look at that aspect too, which you've had with Brookfield Infrastructure.
Yeah, absolutely. If it was just about finding companies with high yields, my job would be super easy.
Yeah.
Often the companies with the highest yields are ones you want to avoid. So we're trying to find those companies with good, generous yield, sustainable in the future, and that they're also able to continue to grow those dividend payouts as well. And that's what really produces returns in the market.
Aaron, we're talking about, I put you on the spot and said, give me a couple of quality stocks that you look at for this side of your portfolio. You focus on, solid growth. You do a great job delineating what you're talking about. Sometimes you have a hybrid growth and dividends. Some are straight dividend sort of payers. Give me another example.
Sure. So I have a really interesting company for you, actually. One of the things we do at our DIY seminar is we break down what are hot themes and discuss whether or not investors should invest in them and how they should approach them. So cannabis, blockchain, crypto, AI, big data. And one space that we really like is cybersecurity. Just the way that the world is digitalizing, the advancements in technology, obviously that opens us up to attack. And we hear all the time about big enterprises being hacked and there being data leaks, and there's a huge economic cost to that. So cybersecurity is a space that enterprises cannot afford not to invest in long term. They have to continue to invest in that. And a recommendation I have from that sector is a company called Fortinet. It's FTNT. It trades on the NASDAQ. So this is a company from our U.S. growth stock service. So it is a pure play cybersecurity stock. It's one of the largest cybersecurity companies in the world, 360,000 customers globally. It's a company that is acquiring market share, so it's growing its market share in the global cybersecurity space. And the sector overall is a growth area, growing at about 11% or more per year is what it's projected over the next several years. And we think that's just going to continue going on as the world digitalizes and companies need to protect themselves. So this is a company that it's not about hype. So we really separate quality businesses from the hype. There's a lot of, anytime you have a hot theme, there's a lot of companies that will just try and jump on that and say they're part of this space to gain excitement. But Fortinet is it's a cash flow positive business. They're growing their revenues. They're growing their cash flow at a phenomenal rate. They're expected this year. They just upgraded their guidance, so they increased their guidance after they put out their second quarter results. They're expecting 17% growth in revenue this year, about 22% growth in earnings per share. So we think that is a trend that you can really profit from long term, and Fortinet is a way to play that trend. One thing I love about Fortinet is that it's fundamentally it's so strong. So it's a cash-rich company. It has over $10 per share in net cash on its balance sheet. Stock price is trading at about $76, and it's actually trading at a relatively attractive valuation, a very reasonable valuation relative to its free cash flow. So when you take the net cash balance out of the stock price, it's really trading at about 16, 17 times this year's expected free cash flow. And that's a very reasonable valuation for a company that is growing, acquiring market share in an attractive space like cybersecurity. And just once again, this is an example of investing outside of Canada too, which is why we have our U.S. growth stock service. Companies like Fortinet simply just don't exist up here, so you really have to go down to the United States to find them. And we're finding some very interesting opportunities down there that you can't access here in Canada.
But it's a great example of, a lot of times investors say, they like a sector. They've done it, one of the ones that jumps to mind right now is, going back a year or two, marijuana sector, but that doesn't mean you're choosing the right stocks. And cybersecurity, thanks to Jim Dines coming on this show, several years ago, and just said, you wait, this is going to be massive. Seems obvious now, but at the time he said it, it sure wasn't. Saying this is going to be massive, the cybersecurity industry. But then it's the job, and that's what you do, of course, Aaron, but the job is to find, which companies are best suited to take advantage of that space. And as you say, you're looking at the growth rates. 17%, fantastic. But it's a great example of the kind of thing you'll do. And it's sort of an example of the kind of thing you're going to be talking about, at your huge list of seminars. So I'm going to remind people again, go to keystocks.com and click on the DIY stock investment seminars, because as I say, they're coming throughout British Columbia, into Alberta, into Ontario. And so get the dates. And as I say, that's the kind of thing I love it when people are doing that, simply because that's how you get a framework, an intellectual framework to hear the information you get, to approach the markets, that kind of thing. Learn how to reduce risk and balance the portfolio. So I'm kind of looking forward to that, Aaron, and great stuff as usual. There's so much to talk about these days. Appreciate you finding time.
Oh, I'm always happy to do it. Thanks a lot for having me, Michael. And we look forward to seeing your listeners at DIY events. We really believe that this is the best investment somebody can make with their time. I'll also add that we provide everybody with a sample starter portfolio, so 5 stocks they can get started with. And this portfolio from last year has returned about 34% over the last year. So just a great way to spend your time, learn about investing, and avoid unnecessary risk and losing money.